I think we all know the pain of screening through countless of stocks, hoping the next one will be the one, but in reality, it's just another miss in the endless search. So, how do we actually find these golden nuggets that the big players manage to find? Or do they just know some insider information that we don't? Well, I found countless growth stocks that have delivered over 100% returns in just a few years, and the screening method I use is actually really simple. The first thing you want to do before screening through stocks is knowing your circle of competence. Ask yourself, what industries do you understand? The reason we do this is because the more we know about an industry, the easier it becomes to research. So it is really crucial to know which industry you understand. With that out of the way, we can move on to the first official step in our screening process, which is we want at least 1 year of profitability for the growth company we're looking at. The reason we want this is because it gives us confirmation that the company we're about to invest in is actually making money, which also shows some proof of concept that their business model is probably working and we could expect some decent cash flow generation. So that is very important. The second step is pretty obvious. We want great fundamentals for the company, and we want this because it will be easier for the company to grow in the future. Now, the fundamentals we want to look at are their return on investment capital, their profit, gross, and free cash flow margins, and their valuation metrics such as price earnings and price to free cash flow ratios, just to make sure we are getting a good deal. Also, we want to make sure that debt levels are healthy. Now, if all these fundamentals are great, that would be the dream scenario. But most of the time, we can't check off all the boxes, as companies have their imperfections. But if most of these fundamentals are in place and there are just a few imperfections, then that is good, as long as it isn't a major risk for the company. The third step is to identify the source of growth and whether it's sustainable. This means we want to look at where the company's growth is coming from and how long that growth is likely to last. We can start identifying the growth by asking ourselves four simple questions. First, is the growth coming from an expanding market? Second, is it due to increasing market share? Third, is it driven by product innovation? And lastly, is it from geographic expansion? If a company can check off at least one of these, then there could be some serious upside potential. But the real key here is to figure out the engine behind the company's revenue and earnings growth. If the growth is coming from a one time event like a post pandemic recovery or a temporary spike in demand, then it might not be as sustainable in the long run. However, if the company is riding a strong long term trend such as AI, cloud computing, renewable energy, or digital health, that could be a big green flag for future potential. And remember, the more durable the growth driver, the more predictable the company's long term performance will likely be, which is exactly what we want as investors. The fourth step is to look for accelerating growth. This means we don't just want to see that the company is growing, we want to see that the growth is actually speeding up. So when you look at the revenue or earnings, check if they're growing faster now than they were before. For example, if the company grew revenue 20% last year, but now it's growing 30%, that's acceleration. Same with profits. If they're speeding up, that's a strong signal. Companies that show accelerating growth are usually doing something right. Maybe their product is taking off, maybe they're scaling well, or maybe they're getting a lot more efficient. And the more momentum a company builds, the more attention it gets from big investors, and that can really push the stock price over time. The fifth step is to check if the market is actually interested in the stock. You want to make sure the stock has some intention behind it because even if it's a great company, it doesn't help if no one is buying it. Now, there's a few things we can look at here. First is the volume increasing. That usually means more people are trading it, which is a good sign. Second are institutions buying the stock. When big companies is moving in, that usually shows confidence. But maybe the most important thing to look at is something called relative strength. This just means that when the market or the industry is going down, but the stock we're looking at isn't dropping as much, that's a strong sign. It tells us there's still demand for the stock even when everything else is weak. And what usually happens is that when the market starts going up again, the stock rebounds hard, kind of like a spring being compressed. Now, I will say this step is a bit more short term minded compared to the others, but it can still be really useful, especially if you're trying to catch the early moves before the stock becomes more obvious to everyone else. The sixth step is to check management quality and insider buying. This is where we look at who's running the company because great management can make all the difference. You want to see if the executives have a good track record and actually know what they're doing in this industry. But here's the real key. Are the insiders buying their own stock? When the CEO and other executives are putting their own money into the company, that's one of the strongest signals you can get. They know the business better than anyone, so if they're confident enough to buy, that's usually a great sign. On the other hand, if you see a bunch of insiders selling, especially from multiple people at once, that could be a warning. Sure, sometimes they sell for personal reasons, but if there's a pattern, you might want to be careful. The bottom line is when management has skin in the game and they're actually buying more shares, it shows they believe in the company's future. And if they believe in it enough to risk their own money, that's exactly the kind of confidence we want to see as investors. Now, you won't be able to screen or search through companies without actual good fundamental data. And that's exactly where the sponsor of this video, EODHD, comes in. EODHD is an API key provider that has data for tens of thousands of stocks, which is absolutely crucial when screening. So make sure to check them out. The link is in the description. Thank you so much for watching. If you want a place to start looking for stocks, be sure to check out the free growth companies I've found for this month, August.